Hello, today is Friday. It is 4:11 p.m. right after the close. 3/4/2022. Today's session in Russia-Ukraine war, inflation midterm, and this is your weekend report. Friendly reminder that this post is for informational purposes only. The views expressed are those of the author, Jonathan Gurney. If you don't know who that is me. The material is not intended to be relied upon as a forecast, research, or investment advice, and is not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. Again, if you have any questions, feel free to see the links below. The Gurney Financial, the website, gurneyfinancial.com. Email me or call me with any questions. This is mainly for clients to keep them aware of what the game plan is, what I'm seeing, giving a realistic perspective. Markets are not in a good spot right now, but I will be honest in saying that we actually held up quite well. You're like, Jonathan, it was an ugly red day, but we actually held up pretty well considering the Eurozone was down almost 5% for most of the day. So we're going to do something a little different this week. We're going to do something called the 3-minute drill, where I basically go through as much as I can in 3 minutes and we call it a day. So it's efficient, fast. You get what you need to know. I'll show you some charts just to kind of show you what we're looking at. The summary of all of this is this. Economically, things are not bad. We're struggling right now because the Fed has pumped a lot of money into the system. The statement, don't fight the Fed, that is a real thing. We don't fight the Fed when interest rates are going up. We usually have a headwind of around 15 to 20% decline, and we're about there, to be honest with you. So I don't think there's a ton more downside. There could be. Price action is really trying to hold key levels, and we'll show that to you. But let's shift gears and we will start the 2-minute drill. 1 second. Okay, so let's go over performance first for the week. This is the NASDAQ, the Russell 2000, the S&P 500, which is our benchmark. And why do we track that? Because it's been difficult to beat and it's very efficient. So a down week of 1.27%. For us, we remained in cash and remained disciplined. You can see that there were opportunities this week, but the key levels did not hold. I'm going to start the timer now and we can get moving. 1 second. There we go. Okay, so weekly performance. There it is. S&P 500 key levels. Shift gears here. We'll try to move quick. Okay, key levels here. I wanted to see a close above 4,400, which is right here. That never happened. So I wish I could have had an opportunity to get in here, and I could have, but I knew that this was the level we had to get above for me to really add and feel comfortable for it, and we didn't. Now, did we bounce off the overnight low? We did, so that's a nice little hold there. There are opportunities, but they're not holding, which is why I'm still being cautious. And when I see the Eurozone down this much, I'm not really too interested in it. This has been sticky all day, meaning holding a key level of about 43.10 most of the day. That is not bearish. I'm not bearish on the market. We just have some headwinds. Don't fight the Fed. We talked about that. When the Fed is adding money to the system, which it's still very accommodative, but when they raise interest rates, it causes some fear. It makes it difficult for high growth stocks to really do well. Now, a lot of that fear has gone out. I mean, if I'm showing you this, again, performance, this is how ugly it's been. And I've shielded a lot of this, but I can't shield all of it because I want to get in at these levels. It's not been pretty. Okay. We've shielded a lot of this, not all of it. So in short, the game plan is to slowly start adding. It's not going to be fun. It's not going to be timed perfectly. What I think will likely happen is I do think we eventually test the 42.22 level right here. It would not surprise me to first potentially touch 44.50 at the 200-day moving average. But rules that I have in place as a trader, as a portfolio manager, when we're below the 50-day moving average, blue line, when we're below the 200-day moving average, when we're below the 5-day moving average and 10 and 20 moving average, you gotta make sure key levels are holding, and they're not. So objectively, it's bad news. It is Not good that inflation is increasing. It's not good with the Ukraine war going on. Understand there's a lot of bad news, and we did not die today. It's going to eventually shift to a point where the news is horrendous, but the market is doing well. That was all of 2021. So eventually that's going to happen. You're not going to like it. You're going to be freaking out. Oh, the world just keeps getting worse, and the market is going to rally. Not seeing that in price action yet, but it's going to happen. So don't get too bearish. I slowly want to keep adding. So that's the game plan. Seasonality, as previously spoken, mid-March gets very choppy. We're kind of right in this range right here. So we could see a pop, probably go lower. So that's a 3-minute drill. That's what I want to keep doing. You know the game plan, seasonality. 3 things that we're combating right now. The Fed has a meeting on the 16th, March 16th. That very well could line up with seasonality and where we really start to ramp. Again, seasonality doesn't always have to happen, but we want to make sure it's been following it to a T. So I have to respect that. You know what I mean? So this could line up perfectly with that meeting. The Fed might say, hey, we're going to raise interest rates, which we know the market actually might say, we already priced this bad news in and let's go. That very well could happen. It happens a lot. Okay? So want to be open-minded to that because it very likely could happen. Here's the intraday price action. Key levels. We could not get over this line all day. And you could see even at the end of the day, we tried to squeeze, failed. We are not dying though. Okay? This was the overnight test low. This, if I were to buy, was the best opportunity. But we're not holding key levels. And when I see this, something's going on. I view these as precursors. Like when COVID happened, the Eurozone was tanking and we were not. Now, it shows strength in our market, but can we hold key levels? That's the next question. So, in summary, are we holding key levels? And is the news bad? The news is horrendous. We know that. But the market is not always going to go down when the news is bad, okay? So right now it is following those news headlines, meaning we probably do have a little more downside coming short term. But we held quite well today, considering well off the intraday lows. People will look at this and say, oh, it's going to tank because it's red. It actually held up pretty well today considering this. I mean, that is brutal. You're talking almost an 8% decline in 2 days for Germany and a lot of the Eurozone area. So considering that it was only down like 1.3% in the S&P 500, this is holding up quite well, and you have to be reasonable about that. I can't save you and keep you happy in cash all the time because then you get mad that we're not making any money. So objectively, it's getting close to time where I need to start adding. I want to be honest about that. Have not yet. Eventually, we're going to have a huge pop, and we don't want to miss it. So big opportunities. Some economic charts real quick. I don't want to spend a ton of time on this, but it's interesting. First of all, profit margins. Is this an economic issue? Profit margins, revenue. Guys, it's not really an economic issue. Companies are still doing well, so don't think like things are overpriced, overvalued. Historically, they're really not that bad. Okay, so don't go down the valuation trail saying things are really expensive. Well, they're really not because profit has increased significantly. Okay, I'm sure you hear that all the time, but I wanted to give you a realistic perspective. All right, so here kind of gives you an idea of what makes up the S&P 500, all the different sectors, and it shows you the weighting. What do you notice? First off, tech is the largest weighting. So if large cap growth tech is not doing well, it's going to struggle, and that is what is happening. All of last year, not all of last year, but high momentum with no great financials got killed last year. And I've been saying that under the hood, it's been ugly, but what was doing okay? The few large cap growth names were killing it last year and made me look like an idiot because I was in cash a long time while the market was tanking. So under the hood, you legitimately have companies that are down 60 to 80, some even 90%. So there's opportunity there. But in this economy, with where we are in the cycle, you got to make sure you're within companies that have true financial statements and not take a ton of risk there. So the summary is this, like, they have all done well the fourth quarter, but if I were to show you an update recently, when the market goes down, they all go down. The one thing that has done better recently has been energy and materials because of inflation. When the Fed is increasing rates, that causes issues with inflation, and they pump so much money in the system, they're kind of in a tricky situation here. So again, remain optimistic. Do not let the news scare you, because what's going to happen, as I keep saying, is the news is going to get worse and the market's going to get better because it prices it in so fast. What I want to happen is a huge, really sweep down. We have not really had the huge scare. This was the one huge scare day. But I think we're going to need something like that to get buyers in. We keep getting these 1% to 2% down days, and it's just not really holding anybody in. So we'll see if we can get that soon. But overall, beat the market, remain cautious at this time for good reason. But I will need to start adding shortly. So thanks for your trust. Have a good weekend. The Shelby Whippets, my hometown, the girls are in the regional finals today. So you can watch that on WMFD. It is free, or Ohio Report, OH Report. Support them. Kind of cool. So kudos to them. It was actually one of the first teams I ever officiated with my dad. So cool history, a little non-market tidbit there. So these girls are really fun to watch, and a great group of girls, and it'll be a really good game. I know the team they're playing because they're from Columbus, a Catholic school. It'll be very interesting to see how this plays out. So overall, key levels not holding above. It can't regain a key level in the market. So got to be cautious and realistic about that, and slowly start adding on the way down. I don't think we very well could test this low here, but I think there's opportunity ahead. So hang in there. We'll be okay. Just got to be patient, which is not easy for investors. And one more thing. Last year, trained so many people to buy every 3% dip. That is not normal. Okay? What is normal is this. The average intra-year decline is 14%. Despite a 14% decline, like even in 2008, went down 49%, closed 38%. A lot of times you get a lot of these down 10%, end the year okay, down 12%, okay, down 9%, okay, down 17%, up 26%. So the summary is this: despite an average intra-year decline of 14%, annual returns end up being positive. So what we're seeing here is well in the realm of normal. You're just not used to seeing it because everything went gangbusters last year. So we have to retrain our brain to say this is actually more normal than what we saw last year, where every 3% dip got bought. As you can see, it shows that right here. 5% dip, 27%, and now this is really tanked this year. So got to be realistic about that, okay? Hang in there. We'll be all right. Just wanted to get this video out for you guys. Have a good weekend.